Meanwhile, new inflation data out today. Consumer prices in July rising 0.1% to an annual rate of 3.4%. The report coming in line with Wall Street estimates. BofA Securities sticking with its 3-rate hike forecast following the print in a note to clients, but it comes with a caveat. Aditya Bhave is behind the call. He is the firm's head of U.S. economics. Aditya, great to have you with us. So still, you're calling for 3. Nothing has changed. Yep. Why?
Sure. So the way we think about the Fed is pretty simple. Compared to a year ago, the unemployment rate is down, inflation is up and further away from target, and yet the policy rate is 75 basis points lower than it was. So that doesn't make sense to us. We think they need to take back those 75 basis points of cuts. They were hedging against downside risks to labor that didn't really materialize. And we think, given where stocks are, there's no sign that financial conditions are particularly tight. Mm-hmm. Feels like policy rates should be higher.
So let's say that's a given. That's the case. Policy rates should be higher. Do you think that will happen?
We think it will, because if they don't hike, then I think we'll be facing a fairly challenging situation a few months down the line. We know there's seasonality in the data. Every time we come around to this time of the year, things look a little more dovish. At the start of the year, job growth is stronger, inflation is higher, things look more hawkish. The difference this time is that the 30-year is already at 525, the 10-year is at 470. If they don't hike now and the data turn hawkish again early next year, they're facing a very serious risk that the long end could get unanchored.
Okay, I'm with you. Until this data point, the jobs number was a disaster. Now, you could say it was a one-off and everything's fine, unemployment rate ticked lower, but under the surface, something else is happening here. So hiking into that could be problematic.
I'm going to push back again.
Please.
I don't think the jobs number was a disaster. The Fed has told us, and I absolutely agree, that break-even job growth right now is pretty close to zero. The labor force is barely growing. In that situation, you're going to get months like this. And then there's the seasonality issue, where we know that the data are a little bit softer on this time of the year. If you average over the full year, we're still growing around 50,000 jobs per month, which I think is absolutely fine, and the unemployment rate's falling.
So you think the market's going to test the Fed at this point? I mean, the Fed has to prove itself.
Yeah. I think so. Yes, exactly.
So let's say at the next meeting they don't hike.
Yep.
I mean, when do your forecast of 3 hikes, when do they happen? When do you think they should happen?
We have them happening in September, October, and December. Admittedly, there's uncertainty around the timing. There's many permutations. Certainly, if the inflation data are soft over the next couple of months, they won't go in September, and they might start later. So we're open-minded to that.
So just coming back to this pressure on the Fed again and on Warsh, I mean, do you think because of the midterms that there's just so much political pressure for them not to hike?
Right. So I don't think they'll start in October. That's too close to the midterms. If they've already started, they might continue in October, but I don't think they would insert themselves into the conversation so 6 days before the midterms. Yeah. So either start in September or start in December.
Well, how about the argument that a big driver of inflation, oil prices, energy prices, they will fall off, that those will dissipate, that the impact of the tariffs will roll off as well, and so therefore we won't have as much upward pressure?
Right. Great question. So we're not focused on headline inflation. We knew headline was going to go up and then come down pretty fast. It's about the core. On tariffs, actually, the 12-month impact of tariffs is probably a little bit lower than it was at this time last year. So tariffs are already rolling off.
Oh, so we have a bigger problem than we think then.
We have a bigger problem than we think. So here's one way to think about it. 3.3% core PC inflation as of June. We think about 40 basis points of that was tariffs, 20 basis points was Iran, and about 20 basis points will get revised away in September. So if everything goes right for the Fed and nothing goes wrong, and that's not how life works, but if everything goes right, you're still at 2.5. That's a pretty big overshoot when the labor market is looking basically in equilibrium, right? So policy should be a little restrictive. We don't think it is. That's why we think they hike.
At what point do you get concerned that the Fed will not act and therefore you will change your forecasts?
Right.
How do you think about that?
Right. So the way we're thinking about that for now is that the proximate risk is a delay to December, and then we'll have to see how the data play out. Okay. Right. And then we'll think about whether they go next year or they don't go at all. But if they go, I think 75 is totally reasonable because you need to do more than just a symbolic hike to truly tighten financial conditions.
Okay. Aditya, thanks for coming by. We do appreciate it.